Welcome, and thank you for joining us for today's live webcast and discussion. We invite you to be a part of the conversation. You'll see a chat box located near the video window. Click Chat as a Guest and enter your name. Feel free to enter your questions, and our moderators will forward them to the panel. We'll repeat these instructions later in the show as a reminder. It is now time to begin, and I will invite your host to take the stage.
Good morning, everyone. I'm Nadeem Hirji, Executive Vice President and Head of BMO's Commercial Banking Business in Canada. Thank you for starting your day with us today, especially for those of you on the West Coast and in the prairies where it's 5 or even 6 a.m. With the federal government tabling the budget yesterday, the first issued in 2 years, we felt it was important to have this call to hopefully provide you with some insight and some clarity. Doug Porter, BMO's Chief Economist, has analyzed the budget and is here to unpack what it could tell us about the years ahead. The current third wave and the challenges that come with it, especially with full lockdown in Ontario and parts of Quebec, and the great challenges across all of Canada, creates a lot of uncertainty. But I think we all still see a light at the end of this long, dark tunnel. Hopefully, the budget gives us all a reason to be optimistic that the country will be well positioned for a rebounding from the pandemic and that it sets the stage for prosperous economic growth. We'll start this morning with Doug's analysis, followed by Q&A. We received many questions in advance on our registration site, many of which will be answered through the information that Doug will provide in his presentation. But you can also submit a question for Doug through the chat feature you see on the screen. So let's get going. Good morning, Doug. I will turn the floor over to you and hope that you can provide us with your views on the state of the country's finances. What are some of the important pieces of the budget that we should understand better, its impacts, and what lies ahead? So with that, over to you, Doug.
Thank you, Nadeem, and good morning, everyone. It's a pleasure to join you here. I have to tell you, I've been covering budgets for a little bit more than 30 years, and this one was truly like no other. And this budget breakfast is like no other as well. This was an enormous document. It was a very ambitious effort. I think, in some sense, as Nadeem said, we did not have a budget last year. In some sense, this almost made up for the fact that we didn't have one in just the scope. It really did touched almost every imaginable portion of the economy. You know, it even had things like a tax on vaping products, for instance. I can't possibly do it justice. The 700 pages, there's literally more than 100 new measures in the budget. I can't do it full justice in terms of each and every one of those measures over the next 20 minutes or so. But what I plan on doing is basically walking through some of the major financial aspects of the budget, and then I'm going to turn around and talk about what it might mean for the economic outlook over the next year. So just to get started, let's begin with the very big picture. There were two main themes in the budget. One was basically getting us through the last stage, hopefully the last stage of the pandemic, and there's still quite a tremendous cost to that over the next 6 months or so, and then laying the groundwork for the recovery in the government's view. You know, their so-called Building Back Better, and the main plank of that was the new national child care, the proposed child care arrangement. But that was just one of many, many measures. Now, in terms of the big deficit number, last year's deficit, which was a record, did come in a bit smaller than what was initially pegged late last year. Instead of the $380 billion that was widely talked about, because of a better economic performance around the turn of the year, it now looks like it'll be about $350 billion. That's for the fiscal year that would have ended at the end of March. Now, the year that's just begun this month, it does look like the deficit will come down and come down a lot. It'll drop by about $200 billion, but it will still be historically large. It is expected to drop to a bit more than $150 billion. That's about 6% of the economy. That's back in the range of things we've seen before. We have never seen a deficit like last year's deficit, but as a share of the economy, a deficit that's about 6% of the economy is something we have dealt with before. And I would just stress that does include a lot of the spending related to the pandemic that will still be in place in this fiscal year. Things like the extension of the CEWS program, more CRB, which used to be CERB, payments that will wind down as we get later into this year. And that's largely why the deficit is still as large as it is expected to be this year. When we get into the next fiscal year, it's then expected to drop again to much, much more manageable levels below $60 billion. That's still twice where we were before the pandemic began. But I would regard the budget deficit forecast for next year and the year after, while still large, a bit larger than I'd like to see, much more comfortable and in a zone of what we've seen before. Now, as I said, there were literally more than 100 measures. Just a few of the other ones I would point to besides childcare. There were, one thing a lot of people were watching for would there be big tax increases? There were a number of smaller targeted tax measures. But I think the good news for most people probably on this line is that there were no broad-based tax increases. We weren't expecting any, but it's still a relief to see that the government does believe that it can get the budget down to much more manageable levels over the next couple of years without resorting to big tax increases. And I think that's one of the major messages that I'd like to leave you with here today. Um, there's a lot of information on this chart. There's a lot of information in the budget. But the one thing I would like to point to on the left-hand side is this looks at spending and revenues as a share of the economy, and it goes back all the way to the 1960s. You can see just what an outlier spending was over the last year compared to any kind of historical precedent. It really was not a revenue story. Revenues actually, they did get a bit dented, but they held up remarkably well. They did drop as a share of the economy to the lowest level we've seen in a great number of decades. But as you can see, the expectation is that revenues will come back and come back relatively quickly and are really not that abnormal in a historic context. But take a look at that light green line. Program spending had basically been drifting sideways for a number of years. It had been grinding up somewhat in the last couple of years, and then it just absolutely spiked. And what that reflects is all the very special measures that were wheeled out over the last year to essentially, backstop the economy through the shutdown, support incomes for individuals, support small businesses, and the number of other special programs that were brought out last year. As you can see, as the economy reopens, the expectation is that a lot of those one-time spending measures will prove to be one-time, and that they will roll off quickly. And even with, things like the new childcare program, you can see that total spending as a share of the economy is expected to be back around 15% of GDP within a couple of years, close to where it was before the pandemic began. Of course, the other thing everyone's focused on, I talked about the budget deficit numbers, is that federal debt line at the bottom. Yes, the federal debt did go above $1 trillion. Last year is expected to rise further over the next few years. Essentially, in the space of about 5 years, going back to pre-pandemic levels, it will have doubled over that 5-year period of time. So when we look at the debt figures as a share of the economy, this is ultimately how we will, quote, pay for the pandemic, is through a one-time big step up in debt to GDP. For years before the pandemic, Ottawa had basically been maintaining a very stable debt to GDP ratio of around 30%. Through thick and thin, we had seen the debt to GDP ratio, quite, as I said, quite stable at close to 30%. And then we had that enormous pickup last year where we essentially went to from 30% to 50% overnight. Now, the expectation is in this fiscal plan that was laid out yesterday is that the debt will peak this year as a share of the economy and actually begin to drift down over the medium term because the economy will be growing faster than the debt will be in the years ahead. So effectively, the government will now be targeting a 50% debt to GDP ratio. It's very unfortunate that it's taken this one big step up from what had been a very stable level for years and years. But I guess if there's any good news, it's the fact that it's still below where we were back in the bad old days in the mid-1990s. In the mid-1990s, the debt to GDP peaked at a little bit more than 70% of GDP. So we're still below those levels that we saw a little bit more than 2 decades ago. Just as if we took this chart way back on the left-hand side, if we went back to the pre-war days, or I'm sorry, the immediate post-war years, we would have actually seen the debt get closer to 100% of GDP very temporarily, and then it came down quickly in the post-war boom. So the level of debt, well, in dollar terms, it's at a record high. It's nowhere close to being a record as a share of the economy. The other good news, of course, is that this has all taken place at a time of very, very low interest rates. Now, I wouldn't want to bank on that forever. There's no guarantees that interest rates are going to remain anywhere close to where they are. We suspect they are not likely going far in the next couple of years, and I'll get into that in a minute. Um, but the overall interest costs of this debt still remain very low. In fact, even with the big run up that we've seen in debt over the last year, the actual interest costs on Ottawa's debt have dropped in the last year just because interest rates plunged so much over the past year. Now, this won't last forever. We will see the interest costs begin to creep up over the next few years, but effectively, we expect them to remain quite manageable. But again, I would stress that does not give Ottawa an open checkbook to freely spend as they like. This low level of interest rates is by no means guaranteed. It's also not guaranteed that we're going to have a robust economic recovery to fuel revenues in the years ahead. And that brings me to the next topic, and that's the economic forecast that this budget was based upon. Just as a reminder, Ottawa, really since the mid 1990s, has been basing its economic projections on the private sector consensus. They've basically taken their hands off of and almost depoliticizing the economic forecast, which I think is appropriate. I'm not going to tell you the consensus always gets it right. We're certainly part of that consensus. I'd like to think we're a big part of that consensus. We don't always get it right, but I do believe that over time the consensus is one of the single best forecasters for the economy. And what this budget is based on is, frankly, a very strong economic recovery. Um, if you can see the numbers there, what the budget is based on is 5.8% real growth this year and 4% growth next year. We think those are actually fairly reasonable assumptions. We're, if anything, slightly more optimistic both this year and next than the consensus is on the forecast. However, by no means is that strong recovery absolutely baked in the cake. You know, we've seen some of the much tougher restrictions, whether it's in Ontario or BC or even Alberta, in recent days and recent weeks. That is going to ding the economy pretty seriously in the month of April. Our view is that this is only going to delay the point at which the economy recovers. It's not going to derail it, but it will take a little bit of a bite out of this year's growth rate. And so, you know, we can't completely be comfortable in the assumption that the economy will see a very strong recovery this year and next, but we do think it's a reasonable assumption. The other thing the budget is based on, as I mentioned, is the continuation of relatively low interest rates. And we did have a big bump up in long-term interest rates to start the year. They have since stabilized and even come down a little bit. And again, it just so happens that our projection for interest rates for this year and next, whether it's short-term interest rates close to zero or longer-term interest rates of a little bit more than 1% over the next year, it's very close to what the budget is based on. But I would just point out that the budget does rely on the nice combination of a strong recovery over the next year and the persistence of relatively low interest rates. We do think that's correct, but there is clearly a risk to both those relatively positive assumptions. Now, the other thing I would point out is, you know, I talked a little bit about Ottawa's still a very significant budget deficit. You know, as I said, 16% of GDP last year, expected to fall to 6% this year. Of course, when you look at the Canadian fiscal landscape, you also have to take the provinces into account as well, and they are very significant borrowers in addition to Ottawa. Now, the good news is, and I would say appropriately so, is that Ottawa really did shoulder the burden of the pandemic costs over the past year and even again this year. Yes, the budget deficits did widen in most provinces. You can see New Brunswick actually managed to almost balance its budget over the last year, but they were the outlier. Most provinces did run fairly significant budget deficits, but it was much smaller than what we saw at the federal level. If you combine all the provincial budget deficits together, they're about 4% of the national economy, which is about a quarter of the size of the federal government deficit. So if we add everybody together, Ottawa plus all the 10 provinces, you do end up with a budget deficit that was close to $450 billion, or about 20% of the economy. That is enormous. That is one of the larger budget deficits in the world. Canada really takes a backseat to no one, I would say, in terms of how much support we saw right across the country, whether it was from the federal government or from the provincial governments. So just to wrap up the specifics of the deficit, I'm sorry, of the budget, I think the main point is before this began, Ottawa talked about spending an extra 70 to 100 billion dollars to, in their words, to jumpstart the economy. They did that one better. They're actually planning on spending 101 billion dollars over the next 3 fiscal years, with the bulk of it landing in this year to again really support the economy through the hopefully the last stages of the pandemic, and to help foster the recovery. Now, our view is that the recovery was likely to be relatively robust in any event as the economy reopened. This will just further reinforce what we expect to be a relatively strong growth pattern as the economy gets through the initial stages of reopening, hopefully this summer and into the fall. With this extra spending, though, the deficit will not completely come down quickly. We do expect it to drop pretty sharply, but it will remain relatively large at over $150 billion this year, largely because of that extra dose of spending that Ottawa is talking about bringing in. Even with that extra spending, we are looking for the debt to GDP ratio to stabilize. It will peak this year at just a little bit more than 50%. It will stabilize in the next couple of years, and then we think it will slowly drift down as that deficit recedes further and the economic recovery is more complete. As I said, to me, one of the key takeaways is many fiscal conservatives. I consider myself mildly fiscally conservative, might be concerned about this wave of spending. But I will point to the fact that even with this relatively aggressive backdrop for spending, the new child care program, we are looking at an environment with no major tax increases. There was a lot of concern about things like the capital gains inclusion rate going up, not just on principal residences, but capital gains more broadly. And there was no talk of that whatsoever. The tax increases were much more targeted. Things like a luxury tax on high-end boats, planes, and vehicles above $100,000. There was a digital services tax, but there were really no major broad-based tax increases. And the budget plan really does see a pretty marked narrowing in the deficit in the years ahead without resorting to tax increases. Now, with that, I'm going to briefly talk about what this means for our economic forecast. This is where I get into the more traditional aspects of my presentation. Certainly, the dominant feature remains the pandemic, especially here in Canada. I talk about a third wave. This chart looks at the number of new COVID cases in Canada, the big 5 European economies, and the U.S. And you can see what stands out there is really for the first time in the pandemic, and this is pretty close to being on a per capita basis. Canada is really seeing as many new cases as any of the major economies at this point. Um, we, I guess the good news is in places like Europe and the U.S., we partly because of the aggressive vaccination process, especially in the U.S. and the U.K., we're not seeing a full-fledged third wave such as we're seeing at this point in Canada. And the vaccine is getting rolled out in a much more expeditious fashion. And so we suspect that after this wave does crest, we are expecting the economy to much more fully reopen through the summer, and especially in the last 4 months of the year. If looking at the budget document, for instance, yesterday, there did seem to be the assumption that a lot of the special spending could be rolled off after September, when I would presume the government too is assuming, because of a much more rapid pace of vaccinations, that we will have a much more full opening of the economy when we get into September and beyond. Now, globally, we are expecting a very robust recovery. This is not just a Canadian story by any means. After seeing, the worst downturn in the post-war era globally last year, when the global economy fell by about 3%, we are looking for the global economy to bounce back at a 6% growth rate this year, and then maintain some of that strength into 2022 when things like the travel industry open much more fully. We're expecting the global economy to grow by 5% when we get out into next year. Turning to North America, it's actually a roughly similar story. I mentioned earlier what our projection was for Canada. If anything, we see somewhat stronger growth in the US this year. There's a couple reasons for that. One is, frankly, and I think we're all aware of that, is how much more quickly the U.S. economy has been able to reopen because of their faster vaccination program. Also, President Biden brought in that a massive stimulus proposal of his own at the start of the year, $1.9 trillion. That's equal to 9% of the US economy. That has already started to juice things like retail sales and housing starts in the US. And so we're looking for the strongest performance of the US economy, the strongest growth rate since 1984 at 6.5%. And if anything, we may even be a little bit conservative or cautious in that view. I actually see the risk to our forecast on the US economy this year to be the upside, and then some of that strength carrying through into next year when we see the U.S. economy still growing by better than 4% when we get out into 2022. As you can see, we see Canada largely growing in line. There'll be a bit of a delay, a bit of a stalling out in the second quarter because of the new restrictions, but then we think we play catch up through the second half of the year and into 2022 when we think the Canadian economy can basically grow in line, if not even a little bit faster for some quarters than the U.S. economy over the next year. Uh, Now we have after that terrible performance or terrible event last year, last spring when we saw unemployment rates shoot up to the double-digit pace in both the U.S. and Canada last April and May. We've seen them come down and come down pretty aggressively. We've seen a bit more choppiness in Canada because of the on-off restrictions that we've seen. We actually do believe the unemployment rate will likely rise in April and May before beginning to drop again. But we are looking for some further pretty dramatic improvement in the unemployment rates in both Canada and the U.S. over the next year. And we think that by the middle part of next year, even late next year, the unemployment rates will be almost all the way back to where they were before the pandemic began, and that the employment market will be fairly close to what we would consider to be normal by late next year as the economy reopens. I talked a little bit about the interest rate environment earlier, and the budget being based on a still low interest rate environment. If we look at the short-term interest rates on the left, these are things that drive prime rates, your variable mortgage rates. These are the so-called overnight rates that the central banks can directly control. We think that central banks in Canada and the U.S. cannot be clearer that they are going to be extraordinarily patient before they raise interest rates. Our view is that it's likely not until 2023 before either the Fed or the Bank of Canada raises these short-term interest rates. They're very close to zero in both Canada and the US. We think that they will wait until we have a full recovery, and a full recovery, especially in the labor market, before they start raising interest rates. And so we see the short-term interest rates really going nowhere over the next 2 years. It's a slightly different story for longer-term interest rates. As I mentioned, we did see these longer-term interest rates burst out of the gates at the start of the year. That's almost a perfect V-shaped pattern you see on the right-hand side in the last 12 months or so. But they have stabilized in recent weeks. And while we do see some further modest upward pressure on these long-term interest rates over the next 18 months, I think in some respects the big move is already behind us. And there is a slight chance that there's any disappointment on the recovery that we'll actually see these rates recede temporarily before grinding higher later this year and into 2022. But there again, I think the big story is that after a very sharp move in the first couple months of the year, we see longer-term interest rates only grinding higher over the next couple of years. Effectively, much like other financial markets, the bond market really did build in a very robust recovery right at the start of the year, and so essentially the market will no longer be surprised by those kind of strong growth rates that I talked about just a few slides ago. Now, one other concern that is definitely out there in the market and among our clients is, given all the stimulus that we've seen, given just this unprecedented bond buying we're seeing by central banks, this persistence of very large budget deficits, is this going to lead to much higher inflation? And we are going to see some pretty meaty inflation numbers in the next couple months, partly because we're comparing ourselves to extraordinary conditions of a year ago. Temporarily, the headline inflation number in Canada and the US will get around 3% or even a little bit higher from what's current readings of just around 1%. But we think these high readings will not last long and that inflation will ease back closer to 2% by the end of this year. And we expect over the medium term inflation to settle back at around 2% or so. And when you're doing your planning over the next 5 years or so, I still think it's very reasonable to base that plan on an average inflation rate of about 2%, even though we're going to see some pretty meaty numbers, as I said, in the next couple months or so. Now, I will tell you that the risks to this forecast are a little bit on the high side and not on the low side. And I think that's an important message. A year ago in the early stages of the recession, the concern was that we were looking at possibly a situation of deflation, an extended period of declining prices, and really no one's talking about that anymore. The concern now is more that there is this outside risk that we could be left with a real inflation problem over the medium term. I still give the risk of that. I assign the odds of that as being relatively low, but I think it's an important message that there's probably more upside risk rather than downside risk to the inflation outlook at this point. Now, one area, just a couple more items I'd like to talk about. One area where we have seen a lot of inflation, and frankly, it definitely got second billing in the budget yesterday, is in the housing market. I just cannot exaggerate how strong the Canadian housing market is. And this is not just a Canadian story, by the way. We are seeing strong housing markets right around the world. But again, Canada takes a backseat to no one on this front. We've not just seen a V-shaped recovery. We've seen something well beyond that. And in many respects, this is the hottest housing market I have seen nationally. And that's the key here. In past housing booms, it's been mostly focused in the large cities, especially Toronto, Vancouver, perhaps Montreal. This time, it's pretty much national. We are seeing strong housing markets almost across the country, especially in smaller cities in Ontario in particular, and to a lesser extent, Quebec and Atlantic Canada. But this is something that is really sweeping the country. We did see some modest measures in the budget, including the tax on non-residents who have vacant homes in the country, but that's modest, stacked up against the tidal wave of demand that we're seeing. Our view is that unless and until policymakers get very serious about trying to dampen the market, it is likely to remain very strong for a period of time. Now, there is some point at which buyers are just going to express exhaustion. Some people talk about the fear of missing out. There's also the fear of overpaying, and I think at some point that will tend to dampen the market a little bit. But at this point, we remain very constructive on the market and believe that it is likely to strengthen further rather than go into reverse anytime soon. The last thing I'll talk about is just the Canadian dollar. Much like almost every other financial market out there, it's seen a very nice recovery from the depths that it hit just a little bit more than a year ago. Our underlying view is that the Canadian dollar is more likely to strengthen rather than weaken over the next year. A powerful global recovery is always good news for the Canadian dollar. We've also been very impressed by the strength in oil prices and the discipline that OPEC is showing at this point. And so those are two very big positive factors for the Canadian dollar. I will say that the dollar barely blinked at the budget yesterday. There was almost no reaction whatsoever in currency markets to the budget, and that's largely because the deficit mostly came in, and the measures in the budget were no big surprise to financial markets. Looking out over the next year, we see the Canadian dollar modestly strengthening. We think it's more likely to strengthen than weaken. Longer term, when we get out 3 to 5 years, I would regard 80 cents as being close to a ceiling over the medium term for the Canadian dollar. I would hazard to guess that a fair value for the Canadian dollar is more in the 75 to 80 cents range when we look out, say, 3 to 5 years down the road. That's it for the formal part of the presentation. I'd now like to invite Nadeem back in to join me for a spell of Q&A. Thank you very much.
Okay. Thank you very much, Doug. Let me start by reminding our guests they can use the chat feature shown on their screen if they'd like to ask a question this morning. But I will start with several questions that we did receive from clients during registration, as I mentioned at the beginning. First one, Doug, that came in is, what do you think we should expect for future corporate tax rates based on this budget?
Yeah, and it's interesting because, as I mentioned, revenues have actually held up relatively well. They have not been the story in the deterioration in the deficit that we've seen in the last couple of years. It really was mostly because of all of the specific spending to deal with the pandemic. Um, I think perhaps the big wild card here for Canadian corporate tax rates is what happens in the U.S. With Biden's big infrastructure proposal. Part of that, partly to pay for that, was the proposal to raise corporate income taxes in the U.S., reversing about half of the tax cut that we saw under Mr. Trump. There's been some pushback on that from moderate Democrats, and I suspect that ultimately we're going to land at a smaller corporate tax increase in the U.S. If and when that does happen, I think that's when Ottawa might take a longer look at possibly moving on corporate tax rates. But it's no foregone conclusion whatsoever that Ottawa is going to follow in the wake of the U.S. I think that does give Ottawa a little bit of room to maneuver if U.S. corporate taxes ultimately do edge back up. But it's not, to me, it's not at all obvious that Ottawa is going to fall in their wake. It just does give them the option. In terms of, the bigger picture in terms of not just corporate tax increases, but tax increases more broadly. My view all along has been the best way to cure the deficit, the best way to, get finances under repair and back to where they were before the pandemic began, is to ensure that we get a full economic recovery. And anything that can possibly frustrate that economic recovery or thwart it is counterproductive. And I view broad-based tax increases as being a threat to the economic recovery. So if I was finance minister, if I was in charge, I would not even be considering broad-based tax increases until the pandemic is completely in the rearview mirror and we know exactly how the dust is settled on government finances. Bottom line is, first we have to wait to see what happens in the U.S., and then I think we have to wait to see how exactly how the Canadian fiscal landscape sorts itself out after the pandemic is over.
Okay. A question actually just came in online, which kind of ties into what you just said, is with the lack of new taxes, or at least lack of increase in taxes, is there a concern that this is an election budget and that then a new government will come in with massive taxes after the fact?
So there's two parts to that question. One is, is this an election budget? I would certainly assume that there's a very good possibility that it can serve as a platform. Given the fact that the average minority government historically has lasted about 18 months or so, and we're getting we're basically almost at that date. I'm almost operating under the assumption that. After the worst of the pandemic is over, we've got a very high probability of looking at an election later this year. So I would regard it as a pre-election budget. Could we be looking at tax increases after the election? Well, I guess that really depends on who wins the election and whether we're faced with another minority government again. I would just very briefly repeat what I just said. I think first of all we have to see what the fiscal picture does look like after the pandemic. Like, do we even need tax increases to really stabilize government finances? And again, significant tax increases could frustrate the recovery, and I just think that would be completely counterproductive until we've got a complete economic recovery at this point.
Okay, thanks, Doug. Another one just came in online. Is there any money in the budget for infrastructure spending?
The short answer is, well, first of all, I would suggest that there was money for almost everything in this budget, and I'm not being facetious on that front. But it's interesting. Typically a normal quote recovery budget or post recession budget would go very, very heavy on infrastructure. There was some money allocated to infrastructure, but it wasn't billed as one one infrastructure bucket, I should say. It was put into a variety of areas. There was, for instance, 6 billion set aside for infrastructure aimed at Indigenous communities. There was lots of money aimed at green energy infrastructure. It wasn't parceled out into a single file of infrastructure. It was basically sprinkled throughout the budget. But I will say, to me, one of the key messages is it didn't really rely that heavily on infrastructure. And that may well be appropriate given the situation that we're in. When you think about this recession and recovery, it's a very, very different from every other one we've seen. In the past, typically what we see is the interest sensitive heavy industries, things like manufacturing and construction are the ones that are hit hardest. They were not hit hard this time relative to, say, the service sector. In fact, of course, the residential construction industry is absolutely on wheels. It just so happens we saw the strongest housing start number for the month of March. This figure just came out yesterday that we've ever seen before. Over 300,000 units were begun in the month of March at an annual rate. We've never seen numbers like that before in a single month. So the construction sector is actually at least on the residential side, is actually quite robust. And so I believe that the thinking in Ottawa was that the construction sector didn't need extra support in these circumstances. And really, what they focus more on is the sectors that have been directly affected by the pandemic and do need a lot more help. Things like the tourism sector and the small business sector is where the real pain has been, and that ultimately does need the support. And construction wasn't particularly in need of a lot of support, and that's why the spending did not rely particularly heavily on what would traditionally be seen as as a typical area to focus on in a recovery, and that would be infrastructure spending.
Okay, thanks. We're going to flip to a different industry. What do you see as the outlook for the automotive industry and its supply chain?
Yeah, and of course the auto sector has faced all kinds of challenges in this episode. It's interesting on the demand side. This has again not been a typical recession and recovery at all. Yes, auto sales and production, almost went to zero last April, but it's impressive how quickly sales have almost completely recovered in both Canada and the U.S. In fact, in the month of March, U.S. auto sales had one of their best months ever in the U.S. And so the demand is certainly there. The auto sector is facing all kinds of different challenges, though. First of all, they're facing the short-term challenge of this chip shortage, which is leading to a variety of production cutbacks that we're seeing, especially here in Canada. And we do think that is going to ding production in a pretty meaningful way in both Canada and the U.S. this year. I guess from the automaker standpoint, is the positive news is they're going to have a lot of pricing power this year, because I think there actually are going to be shortages of in particular makes this year in North America. Longer term, of course, we're obviously looking at this profound transition to much more emphasis on electric vehicles over in the years ahead. Of course, that carries incredible implications for right up and down the supply chain, significant changes. Of course, there's the parts industry is facing a major transformation in the years ahead. Fortunately enough for Canada, we do have a lot of mandates now to build electric vehicles in the years ahead, but it is going to be a real challenge for the parts industry in particular. Of course, the other issue we're dealing with, and I think the questioner is really hitting on that, is, we do face, I think, a fundamental review of supply chains right across the board. I think, industries, manufacturing in particular, have come face to face with a lot of significant challenges with lengthy supply chains through the pandemic, and I think there's going to be a wholesale review and potentially a reordering in many industries of supply chains. I think ultimately supply chains in a variety of industries will be shortened, and I suspect that does include the auto industry as well. That doesn't mean it's going to be the case for every for every manufacturer, for every automaker, but I do think whether it's the transition to electric vehicles, I should say, the short-term chip shortage, or this review of supply chains. The auto industry faces an incredible transformation over the next 5 and 10 years, I believe.
Okay, thank you. I'm going to ask you to put a bit of a fortune teller hat on here, but what is your assumption or forecast regarding timing of the opening of the U.S.-Canada border?
That is a tough one, and of course that's one we've been dealing with, really since the pandemic began. Obviously there's pressure on both sides to open the border as soon as safely possible. I suspect that will be the day when governments on both sides have determined that we have reached something akin to herd immunity. My best guess is that that's when both economies can pretty much fully or close to fully safely reopen. My best guess would be something like September or October that we'd be looking at. So it's likely after the summer tourism season. Again, I have no particular inside information on that, or special insight. That would be our best assumption, though, at this point.
Okay, thank you, Doug. We all saw after this was tabled the reaction to the budget from the other political parties, the NDP, the Conservative, interesting words that they both chose to speak of. When you think of their reaction, do you think there's a serious possibility that the budget will fail to pass?
I don't. I actually, of course, the government really only needs one party to support it, and I thought Mr. Singh was incredibly clear. He effectively said he thought it would be irresponsible to have an election in the middle of the pandemic. Frankly, I thought the budget probably ticked a lot of boxes for the NDP. So I would be surprised if the NDP would not support uh, the the budget. Um, I think the question is whether the sitting government, ultimately wants to call an election. I suspect they will not be forced into calling an election. I think it will be the government's choice ultimately. I'm under the assumption that the budget will pass.
Okay, thank you. Question that just came in online. What concerns do you have with bankruptcies, both personal and corporate, once the government programs end? I know some of them were extended in the budget to the fall of this year, but I think the concern is around it's not a never never plan. We all get that. So what are the concerns, once the merry-go-round stops, so to speak?
So, and first of all, just taking a step back, this has been an extraordinary recession and recovery historically, and I think one of the most extraordinary features of it was the fact that we saw a collapse in personal bankruptcies in the last year. And it's there's no mystery what's going on here. It was due to the incredible level of government support. It was also the fact that people were able to defer their mortgages if need be, and it was because of the steep drop in interest rates too that made debts more affordable. Um, I believe that we are not going to see a significant run up in personal bankruptcies over the next year, even when supports do fade away. Frankly, if the government's going to err on this front, it's that they'll if they need to keep these support programs running longer, they will. If they're going to make a mistake, it's that they err on the side of being too generous. So I think that we are not going to see a significant run up in personal bankruptcies. Business bankruptcies are a different story. They too collapsed over the last year, but I don't think there's a guarantee that they're going to stay low when we're on the other side of this. I think a lot of businesses are just hanging on, especially in sectors that are directly affected. Some have just shut their doors, haven't necessarily declared bankruptcy. I do believe that that does not give us the full story. The drop in business bankruptcies over the last year. I am concerned that when we're on the other side of this, that when the economy is reopened and businesses can, completely reassess where they stand, I think we could get an echo of business bankruptcies on the other side of this.
Okay. In the budget, was there anything more for the heavily hit industries, travel, tourism, hospitality?
There was a little bit. There was, in this day and age, $1 billion sounds like a little. There was $1 billion aimed at rejuvenating the travel and tourism industry. There was a fair bit of money spent into essentially, I would say, making people more comfortable traveling by airplanes as more of us get vaccinated. There was all kinds of money set aside on that front. But most of it was just the extension of programs that are already in place, there was an attempt to target it a little bit better at sectors that have been more directly affected. But there was not, say, an overwhelming large package aimed at supporting the travel and tourism industry. It was more, I would say, more of the same, of general levels of business support and support to, help firms reemploy people as they're able to reopen again. It was almost a Q's on steroid. I'm sorry, I actually do not remember the name of that program off the top of my head, but basically it was almost subsidizing half of the pay of workers as they reopened in the initial months over the summer and into the early fall. But industry specific stuff, there was not a huge new program, no.
Okay. Doug, is there anything in this budget that you expected to see or hope to have seen that's not in there?
The one thing we were angling for, at least in the economics department, is we were hoping for, something along the lines to try to cool demand a bit in the housing sector. It wasn't there, not in a significant way. I'm really not surprised though. Frankly, the housing story has really dominated the airways for weeks, and I believe the government didn't want the housing industry to soak up all the oxygen when there were so many other different important announcements at this point. Frankly, I was relieved not to see any significant tax increases. I was somewhat comforted by the expectation that the budget deficit would come down back to around the 30 billion limit in the years ahead. But frankly, as I said at the outset, there were more than over 100 measures here. I almost would have hoped for less rather than more. My view is that the government's role really is to get the economy through, as I said, hopefully this last stage of the pandemic, to get us through to the other side. I really think that should be the job number one, is really supporting, accelerating and supporting the vaccination program as much as possible, because really that does hold the key to getting the economy onto the other side of this. So short answer is no. There was nothing significant that I was really looking for, and that wasn't there in this budget.
Okay, thanks. And just on that note, you mentioned getting to the other side. A question came in saying, is the budget built to withstand another wave of COVID?
It is, I would say it is built to withstand the wave that we're going through now. I would say the assumption is that a lot of the special programs like the Qs and the CERB Lite or CRB that's now in place, are the expectation is that they will be able to be wound down by the fall. This budget is not prepared for yet another, if it comes to that, yet another big wave, say later this year, and another round of restrictions that might be needed later than that. I guess the good news is, while that would dent finances, certainly, I think it's fairly clear that the economy has largely learned to deal with restrictions. It's certainly not an ideal world by any means, but it does seem like much of the economy has been able to at least grind through the restrictions, at least temporarily. And I don't think the fiscal cost would be particularly huge if there was a fourth wave. So it would deteriorate government finances further, but I don't think it would completely alter the picture. And by the way, just as a quick reminder, if you go back to November, really the budget wasn't assuming a huge significant second wave at that point, and the ultimate the end deficit figures really weren't that different from late last year, or even with the second and the third wave restrictions that we've seen.
Okay, thanks, Doug. We talked a little bit, a couple times, about the housing market, the strength of it being across Canada. and that not much was in the budget that's going to really cool it down. You mentioned that something that perhaps is one thing that you thought would have been in there, but is not. The question is, what do you think is an appropriate and efficient measure that could have been in there to cool down the real estate market?
And just to reiterate, I really wasn't expecting them to really do anything in the budget, and it does, measures that could cool the housing market do not necessarily have to be in a budget. They can come at any time, and I don't, just because they didn't do anything yesterday doesn't mean Ottawa is going to completely stand aside over the next year, especially if the market remains anything close to as hot as what we saw in the month of well, really through the first 3 months of the year. We actually put out a piece in the economics department a few weeks ago that listed 10 potential measures. I wouldn't say we ranked them in order of feasibility and worthiness, but it was pretty close. Frankly, right at the top of the list is, ultimately lies at the feet of the Bank of Canada. I think one thing the Bank of Canada could do without raising interest rates is just, stop talking about interest rates remaining low forever. Maybe just the opposite. Start reminding people that interest rates can move up at some point. In terms of what the federal or even the provincial governments can do, we had a whole list, variety of topics. The reality is, though, almost anything they do will have side effects and are not going to please everybody by any means. One thing provincial governments could do, though, we've seen a non-resident tax in the Golden Horseshoe in Ontario, but it doesn't apply to a lot of smaller centers in Ontario, and that's where the real heat is these days. Places like Sarnia, Windsor, London, Ontario, which don't have a non-residence tax. It may not be that effective, but it really doesn't have that many negative side effects either. And even if it just acts as a signal, that the provincial government is uncomfortable with the pace of price gains, that can have an important effect on the market just by signaling that it can break the psychology that we're seeing right now, this fear of missing out, which we think is fanning the flames. The other thing we talked about was doing away with blind bidding, which we think is really ballooning housing markets, and doing away with that would have few side effects on the rest of the economy. So we would actually rank that as one of the top things that can be done to at least throw a little bit of a wet blanket on the market.
Okay, thank you, Doug. I could probably keep you here all day. We received a lot of great questions, but we are unfortunately out of time now this morning. So thank you, Doug, for sharing your insights with us this morning. As always, they were very informative and extremely insightful. And thank you to everyone who joined us today. We will have a replay and a recap on our website soon at bmo.com/commercial. We thank you for your time, your partnerships, and your business, and hope that we've been able to provide some added value here for you today. And if you have any questions that we weren't able to address today, please don't hesitate to reach out to your BMO representative, and we will, of course, get you an answer. Thank you again for joining us today. Please stay safe and, of course, stay healthy, and have a great rest of your day. Thank you.
Bye, everyone.